Welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer. So thankful for you to give us a few minutes of your time. Also have a very special guest, Joseph Clark, CFP, Managing Partner, Founder, probably a lot of other things behind that as well. So Joe, so glad that you came on board and joined us this week in this week's Market Carver edition.
It is awesome to be back. We've been doing the Market Carver since October of 2007 and have missed 1 week in the last 15 years. So I'm excited to be able to be here and just to be able to sit in and join the fun.
Yeah, it's good. Well, to pick your wisdom and your knowledge in several of these categories. So certainly feel free to jump over me as you see fit as we go over this week's topics, where we picked out 4 to cover from this week's meeting. We're going to talk a lot about bonds. That seems to happen with me a lot. It's just my view of the universe is that bonds are at the center of it. But the reality is, with interest rate changes, certainly when they're the drivers, they certainly are. So we're going to talk about double B bonds as proxies. It's a mouthful, but explain why there might be some interesting developments in that category. We'll look at high yield trends, something that we look at each and every week as part of our risk barometer, and share with you when something relevant happens. China COVID trends. So just can't seem to get out of talking about COVID, but this time it's in a positive light. And then we're going to look at real yield assessment. So Joe, if you're ready, we'll dive right into double B bonds and what they may be telling us. All right. Yeah, so double B bonds is proxies. So all you see on your screen is a chart. But let me explain to you why that chart I think is important. So double B bonds, what that tells us is that they are the demarcation line. They are the safest of the riskiest. Joe had a less PC way of calling them that I liked, but I'm just going to say the safest of the high yield category. So if you go to triple B, that's what we call investment grade. So if you look at most of the American corporations now, they are triple B, which means they are investment credit or investment grade worthy. So they have lower interest rates. Double B is on the riskier side, but they're on the safer side. But why this is an important space is that they have characteristics of both stocks and bonds. So they are bonds. So when interest rate changes, they're going to have some of that flow through, but they also, being on the riskier side, have some elements of stock influences on them as well. Certainly when we have deterioration in the economy, that flows through. So you can really see a little bit of both worlds in this yield. And as you look back over the past year and go into 2021, what you'll see is that this was stuck around 3% as a yield. Now, that may not mean anything to you, but just from observing and looking at this periodically for a number of years, that is very low. For taking on the risk of companies that are not necessarily in great standing, you were only getting 3% of an interest rate in return. So we really avoided these like the plague, because 3% just isn't enough to cover you if just a handful of them go bankrupt. But now, in just a few short months, we have spiked all the way to 6%. Which is actually near the top of what we've had over the past decade. So we can't tell you, Joe can't tell you, I can't tell you if this is the top or this is the maximum it's going to go. But what we can say is that in short order, that yield has doubled, and to us represents a much healthier starting point for investment asset classes. And this goes for both stocks and bonds. So Joe, any additional insight or things that you would add into double B bonds and how we should think about it?
Yeah, just a couple things. And you pointed out, and for those of you who don't know, we have an allocation meeting every Monday that the team takes part in. So Adam and Andrew and Zach pretty much lead that meeting. And there's usually 10 to 12 of our advisory team that are on the call. And one of the things that Adam pointed out in that meeting that I think is noteworthy, this is the top of what we would call the junk bond level. But any business that in its right mind with interest rates as low as it was, did everything that it could to leverage its balance sheet appropriately just to that level, so that they weren't necessarily the top grade, and very few companies have that status, but they clearly weren't the junk part either. And I think one of the things that this chart shows is it illustrates how quickly a market can move, whether that be in the bond environment or the stock environment. And that's why it's so important to be able to watch and have a playbook already in hand to say, okay, when this happens, then we have the ability to respond accordingly. And we're not just caught reacting with our hands in the air going, what now? And I think they do a really, really good job of that. So even though you hear it called junk, and it is, all of a sudden those rates are really getting to be quite attractive. And it could go higher, but then again, it could go lower. Our job is to do the best with the risk and the information that we have today. So that works for me, Adam. I think it's a great job in explaining it.
Yeah, and I'll just add tactically. So the natural question you may be developing is it time to start adding some of those attractive yields? And in part, the answer is yes. Actually, there are some dislocations. And because we had most of our portfolio positioned in much safer, and actually some of the very rare AAA, which you just don't find, we had a lot of safe bonds in the portfolio, which means they were able to preserve value so that we have the opportunity to grab, not in oodles, but just around the margins, grab some of that yield. And we'll continue to do that if the situation stabilizes or even goes on up and gives us more yield. So sticking with high yield trends, sticking with the same asset class, but really showing you how the market is developing. All right. And so in many ways, this is going to be very tied to the previous chart, but just looking at it in a different light. The panel to focus in on would be on the far right. So we can kind of ignore the U.S. Treasury yields. That just gives you some perspective. But the middle is the yield, and then the right is you see the average price. And if you go back just earlier this year, the average price for high yield bonds was over 100. So why that's significant is when these bonds are maturing. So bonds have a death date. You know when they're going to be no longer investments, when you're going to get your money back, hopefully. We know that you're going to get 100. That is the maximum that you'll receive on these bonds, but they were trading at what we call a premium. And that premium has not only evaporated, but has turned into a wide discount, and it's developing there even more rapidly. And why that's important. Number one, it feeds our risk barometer. When this is going the wrong direction, it tells us that investors are beginning to demand more return for their investment. So it filters on to other asset classes. But more importantly, the higher these yield goes, or the less price people are willing to pay for high yield bonds, it makes it much more difficult for current companies to go to the market and raise money. And that is necessary to pay off prior bonds or to grow and expand their businesses. So that's why this is a direct feed and a challenge, and certainly something we want to see stabilize before we move too far off of the defensive end.
When you look at this, guys, it becomes very, very complex. I've even noticed on CNBC they've started to change some of their lingo. And if you've been around me for a long time, you've seen me do the teeter-totter. When interest rates go up, the value of the existing bonds on paper go down. And that's what Adam was just referring to in that chart when you see something now trading at a discount. Because the interest rate is higher, the value of existing bonds have gone down. It will still mature at 100. Right? The discount will evaporate over a period of time, but it's important to understand this. Now, those of you that are watching the market, Carver, clearly understand that for the most part. Interest rates down, then the value of bonds go up. Interest rates up, the value of existing bonds go down. But it is a nice way to be able to explain to people who have wondered what in the world has happened. And Adam has shared this on the market, Carver, throughout the first part of this year, that we have seen one of the largest drops in bond market in history, relative to what's going on because of that fast-paced move of all the existing bonds that are out there and the interest rates rising very, very rapidly, right? So to speak. The idea that they're safe every day of the year by being safe, meaning less risk, is evident in that chart that that's clearly not the case. So the risk barometer has served us well in the past and is doing it again this year, so that Adam has the ability to put that money where it really belongs, based on a risk-adjusted performance.
Awesome. Thank you, sir. We'll move the page now and talk about China and the COVID trends. And this is important because, as you probably know by now, China has taken a very strict COVID approach. This is much more about its direct impact on the economy than it is about COVID or its possible spread to other countries. The reality is, because China took such a harsh approach and shut down parts of their economy again this year, we were adding pressures to supply chain. We had manufacturing slow down there, which is the last thing that we needed when we're already battling inflationary pressures. So it's noteworthy that we see and reported infections coming back down and hopefully get them back to work over there and reboot that part of the supply chain. Joe, I know we're just so sick of talking about it, but unfortunately, we are still tied as a global economy, and when China takes such drastic measures, we're going to feel it.
Yeah, and there's no way around that. When you have a business, regardless of what it is, you can have extreme interruptions by supply chain. And I don't really recall, and I could be wrong. I've only done this for 35 years, so I forget some things. But I don't ever recall seeing a supply chain this interrupted or disrupted, I should say, in so many different places, from our people who own plumbing companies to those who manufacture semi trailers. It has just been across the board, not just the chips that you hear in the automotive industry. And that disruption, you've got to understand, seems to be very, very negative in it. And it does put a weight on an economy and invariably a weight on the market. But it also provides opportunity in the form of dislocation, where people start to price in that, oh my God, this is going to happen forever. Please, I'm praying, help me. And the bottom line is, this is not a forever issue. It is a challenging issue. It's one that's going to go on for some time, certainly in different sectors, and hopefully China can get their stuff squared away with COVID and what's happening. And our prayers always will go out for the people in the Ukraine, hoping that resolution can come to an end and a resolution or resolve there. But the bottom line is, the supply chain being interrupted does create disruptions, but it also creates opportunities. Those we're on the look for all of the time.
Yeah. And our last topic of the day, we're going to hit real yields. And this may be the 10th time that we've hit it this year. It's just one of the things that's been right on my dashboard, one of the main things to look at each and every day, because I believe there's so much going on in the Fed. You could read in pages and pages what they're trying to get done. But my belief is, one way or the other, you can see it on this chart. And you can see it because real yields, which is the yield you can get on United States government debt minus inflation, was negative, minus 1%. And that's just not the correct monetary policy or the right direction in a healthy economy. And so the Fed now admits that they left these too negative for too long, and that they were going to take care of the situation. But one thing interesting as we go through 2022 is that the market did not catch on at first. They stayed negative 1% until the Fed just kept coming through it time and time again, that they are going to do what it takes to get interest rates higher and on top of this situation. And so we finally see that cross to the positive. We now have a positive real interest rate. That doesn't mean that we're through this or all the markets are finishing adjustment. But you can see, going from -1 to 0, there was a lot of asset classes that had to reprice. Not just the bonds, but high-tech growth stocks everywhere around the world. And also, we give you a range here. You look at this as a long-term chart. I think the last 10 years is going to be more applicable than the prior 10. We've got different demographics. We've got a different global economic backdrop. And over those past 10 years, a positive 1% has been the upper ends of what the real rate has been. So to me, that just opens up a reasonable framework of what we might be looking at in terms of how far they're ultimately able to go. Now, to do that, they're going to have to follow through and raise several more times in large chunks. But that, I think, gives us a reasonable framework to analyze where these might go.
Hey, if you think about this for a second, I've been talking and beating on inflation for as long as I can remember, even in a period of time when inflation was really down and people thought it was a dead issue. It just made sense to me that inflation had to come back. And it's why when the planning teams talks to you about the fiduciary focus, they've always said there's 4 things: risk and volatility, fees and expenses, taxes today and tomorrow, and real return. And you really have to have that combination of all 4 of those in the forefront of your mind. And, Adam and I have done this for a long time. Adam joined the firm back in 2000. Here we are in 2022. We've done this for a long time. And we've jokingly said we've always had people who could tell us the top end of the market and the bottom end of the market by some of the phone calls that we're able to get. Well, now that I've reached this magical age of 55 and got my AARP card in the mail with the coupons my wife assures me we could use, now that we've reached that age, I start getting calls from brokers. And so we've got another signal that we can use of knowing when things may have been overextended. And we got a call today where somebody was trying to sell me indexed inflation bonds. Now, I'm not telling you that that's a bad idea. I'm just letting you know that the world, from a marketing standpoint, seems to be about 2 steps behind what's really transpiring. What you and I need to be thinking about, certainly what Adam and Andrew and Zach are thinking about on a daily basis, is really where we already are, not where we've been and trying to play catch up. And we don't try to forecast the future. As Adam indicated earlier on in this conversation, there's no way for us to correctly predict what is going to happen. And I want to share a study with you that was done over 1,065 studies that was done by a McKinsey and Associates, one of their consultants, that was created. It looked at S&P 500 companies, 1,065 decisions that led to product launches, mergers and acquisitions, et cetera. Things that affected the bottom line, profit, revenue, market share. And of that 1,068 decisions, you've got the ability to predict the future and make a call, if you will. And then you have the process of the decision. So you've got the analysis and then the process part. And it was just shocking to me that when they went through and they did the study, that the effectiveness of the process of the decision was 6 times more impactful to the positive side than simply having the good analysis, i.e. having all of the information. And so Adam and I have always looked at it every week when we come to you on the Market Carver. We've always looked at it that there is going to be an abundance of information out there, an abundance of what my engineer friends call noise, that we simply don't have access to or know that's even going on. What we do have, though, is a controlled process that we're able to use that correctly looks and identifies what's happening based on a decision-making process that Adam has spent a lot of time working on. And that's where we have our reliance, not in all of the crazy noise. We don't try to predict where the S&P 500 is going to be or where the market's going to be tomorrow for that point. We do work on that decision-making process, and that part makes me happy. We're always happy to share that with you on the Market Carver. And Adam, thank you for letting me join you today, buddy. I certainly appreciate it. If you guys are out and about on Saturday morning, you'll be happy to know, I think, effectively, the first week in June, I will be back on the radio on a weekly basis. And if you have any questions or any comments, anything that the team can help you with, don't hesitate to reach out at 800-928-4001. We are always here and more than happy to have your questions. It's great to be back to visit you guys. Have an outstanding week. We look forward to seeing you again soon.